Hey traders, and welcome to another episode of Smart Risk. Identifying institutional supply and demand zones is the key to becoming a profitable trader. Most of what you think you know about supply and demand might just be scratching the surface. If you can master supply and demand, you'll be on the same side as institutional money, rather than being on the opposite side, where you could become a victim and get trapped. And that's exactly what we're going to cover in this video. We're going beyond theory, diving deep into supply and demand step by step. We'll break down the key points and concepts you need to master, from the basics to advanced levels. We always appreciate your support, so please give this video a thumbs up and subscribe to our channel if you are new. See you after intro. Welcome back, traders. So let's get started. Let's quickly explain the actual meaning of supply and demand terms in a currency pair trading session. The supply is the amount of a currency available for trading. When we talk about supply in the forex market, we're referring to how much of a particular currency, like the US dollar or the euro, is out there and ready to be exchanged. When there's a lot of currency available, it means the supply is high. On the other hand, we have demand. Demand represents how much traders and investors want to buy a currency. When many people want to buy a currency, it means the demand is high. If demand for a currency goes up and supply remains the same, the price of the currency will go up. If supply goes up and demand remains the same, the price will decrease. When there is a significant imbalance between supply and demand, the price will continue to move until it reaches enough liquidity to rebalance. For example, if the number of buyers far exceeds the number of sellers in a market, the price will sharply push upward until it encounters a supply area that can meet the demand, bringing the price back into balance. Each time a buy position is executed in the market, someone on the other side must be willing to sell to fulfill that buy order, and vice versa. These dynamics drive the price of currency pairs. Buyers create demand, pushing prices upward, while sellers provide supply, applying downward pressure on prices. Behind the ever-changing price of any currency pair, millions of orders are executed by a diverse range of participants, from individual retailers to large financial institutions. This activity creates imbalances in the supply and demand of the currency pair. These behaviors and participations also generate the order flow of a currency pair, which is what prints the price action on our charts. Each currency pair has a unique order flow in every trading session, recording the behavior of all participants. By analyzing this order flow, we can detect the actions of financial institutions and decode their strategies, allowing us to make high-probability forecasts about the price's future movements. Remember, financial institutions cannot hide their footprints in the order flow, providing us with valuable insights into their behavior. The market is like a continuous cycle that constantly seeks to rebalance supply and demand imbalances by moving toward liquidity areas. As we discussed earlier, institutions cannot hide their order flow or the significant imbalances they create in the market. By learning to identify these footprints on a chart, we can align our trades with the direction of institutional money flow, avoiding being caught on the wrong side of the market and becoming part of the liquidation process. One of the best and safest ways to trade alongside financial institutions and identify their order flow is by accurately recognizing supply and demand areas on the price chart. Now, let's see how the supply and demand areas are formed in the market. Price usually before making a drastic move in the market, it typically forms an accumulation or moves sideways within a narrow range on the chart, known as the base. This phase acts as a temporary pause, allowing the market to gather more momentum. During this period, the market induces more players, including retail traders and financial institutions, adding liquidity and setting the stage for the next move. For example, the price drastically moves upward in a bullish scenario and breaks the base zone. This is caused by a sudden and unusual increase in buying pressure, leading to an overwhelming imbalance between supply and demand. Hence, the price rapidly pushes upward and breaks out of the base to find more liquidity to consume enough supply and rebalance the recently generated demand. This is precisely how demand zones are formed. To take advantage of this, we need to wait for the price to return to the demand area and then look for our entry models to execute long positions. This allows us to be on the same side as institutional money. So why does the price react to the demand and reverse from it? The main reason the price comes back down and mitigates the demand zone is that there isn't enough demand to keep pushing the price higher. The price finds a new supply to consume and fills the current demand, resulting in a decrease in price and a pullback. The reason that the price reverses from the demand zone is due to institutional money footprints in that area. Previous institutional buyers have entered long positions there and will not allow the price to drop below their executed price to keep their initial positions profitable. In simple terms, institutional money will defend their long positions at any cost. The reason these zones are respected and the price reverses from them is that banks and large financial institutions enter trades gradually and in multiple stages, especially in areas where their previous trades have left footprints. This means that not all of their original orders were executed initially, and they are looking for an opportunity to go long with their remaining orders at the demand zone. This is why we should wait for the price to return to the demand or supply zones before considering executing trades if we want to align with institutional money instead of becoming a victim and getting trapped. All these processes occur in 4 distinct steps: the base, the expansion, which can either be a rally or a drop, retracement and mitigation, and finally continuation. We always focus on the continuation phase when entering the market. The same concepts apply to the formation of a supply zone. Price moves sideways within the base, and then suddenly, selling pressure starts to rise, causing a significant imbalance between supply and demand. As a result, the price dramatically pushes to the downside and breaks through the base. Next, the price returns to the supply area to activate the remaining institutional short orders and fill the imbalance between supply and demand before continuing its bearish order flow. To go short from this area alongside banks and smart money, we should wait for the price to return to the base and supply area again. Then, we can consider opening short positions. As institutional money re-enters the market, the price continues its bearish order flow, creating new bases in its downward movement. This process repeats, forming new supply areas until the bearish momentum subsides. How do we use supply and demand in smart money concepts, or ICT? As you know, the market is fractal, meaning that everything that happens on one time frame also occurs on higher or lower time frames. Price patterns like trends, ranges, and reversals look similar, whether you're on a 1-minute chart, a daily chart, or a monthly chart. For example, let's say we see a demand area form on a 1-minute time frame. When we switch to a higher time frame, like the 15-minute chart, we might notice that the entire base area from the 1-minute chart looks like a single selling candle that is formed just before a rally. We refer to this as a bullish order block. The exact opposite happens in the bearish scenario. The base area on the higher time frame might appear as a single buying candle that was created just before a downward move. This is called a bearish order block. The order block is the last buying or selling candle that forms just before a rally, upward movement, or a drop, downward movement expansion. Essentially, the order block is a single candle that appears right before market makers and institutional money decide to manipulate the market by creating a shift in market structure or driving a drastic trend continuation. Before we continue, if you're curious about how we stay updated on financial news and fundamental analysis, well, we rely on Fastbull, one of the best trading websites with various useful trading tools. This site provides one of the most accurate and detailed economic calendar, a tool we use every day before starting our technical analysis. 24/7 economic live streaming also allows us to stay informed about the latest trading world's news and fundamental analysis. So if you want to benefit from multiple trading tools that can significantly improve your trading, make sure to check the link in the description. Now, what are the main types of supply and demand? Supply and demand zone formations can be categorized into different types, including reversal patterns, continuation patterns, and flip patterns. Starting with the trend reversal base, this pattern indicates an upcoming market structure shift from bullish to bearish or vice versa. It has 2 common types: The first one is the drop-base rally pattern. In this pattern, the price drops and moves sideways within the base. Then, suddenly, buying pressure starts to rise, causing a significant imbalance between demand and supply. Subsequently, the price rallies upward and breaks the base, signaling a trend reversal from bearish to bullish. We look to go long if the price taps into the base and demand again. This allows us to align with institutional money. The exact opposite happens in the second pattern, rally base drop. The price rallies up, consolidates, and creates a base, then drops and breaks the base to the downside, suggesting a potential market structure shift from an uptrend to a downtrend. The second main pattern of supply and demand zones is the continuation pattern, which indicates that the price is more likely to continue its dominant direction after a temporary pause. Here are the two common types of continuation patterns. Drop-base drop. In this pattern, the price drops, then experiences a temporary pause and generates a base area. Subsequently, selling pressure rises, and the price breaks below the base area with solid momentum, suggesting an upcoming continuation of the downtrend. We would take advantage of this pattern if the price returned to the supply area. Rally base rally. The price rallies upward, forms a base during consolidation, then breaks above it, and continues pushing upward, indicating increasing buying pressure and positive market sentiment. And finally, the third main pattern of supply and demand is the flip pattern. The flip pattern is one of my favorite patterns and trading strategies. I always look for it and try to trade it when analyzing the market charts. It refers to a specific price pattern that signals a potential shift or flip in the market direction. Simply put, a flip pattern is about reacting to a supply or demand zone and then breaking it. Generally, this occurs when a previous supply or demand zone is broken in the opposite direction, causing it to switch its characteristic from supply to demand or vice versa. Flip patterns are divided into two common categories: supply to demand flip and demand to supply flip. For example, a demand to supply flip occurs when the price is in an uptrend, creating successive higher highs, but suddenly the price can't make higher highs anymore. It taps into the latest demand zone, and after a minor rejection, with increasing selling momentum, the price breaks the latest demand zone to the downside, indicating a trend reversal from bullish to bearish. Every time the price breaks through a key demand or supply zone, that area switches its characteristic. A supply zone becomes a demand zone, and a demand zone becomes a supply zone. So now, the previous demand turns into a new supply since the price is more likely to mitigate it before resuming its bearish order flow. We would consider going short if the price gets back up again to mitigate the newly generated supply zone. The same concept applies to the supply to demand flip pattern but is reversed. It's important to note that trading flip patterns require specific rules and criteria to be considered and taken into account. We will cover all those concepts in detail in future episodes, but for now, let's see how we can identify supply and demand zones from a candlestick perspective. There are three ways to highlight a supply and demand zone in candlesticks. The first involves considering candles inside a range. The second focuses on the pivot candle, and the third highlights a fractal as the supply or demand zone. In the first method for drawing a valid supply and demand zone, we focus on the candles inside the range just before the price breaks that zone with a strong expansion move. The second method, the pivot zone, occurs where a pivot in the price is caused by a single or two candle sequence formed just before the price starts a significant bullish or bearish expansion. You can draw this from a single candle that is engulfed and formed right before a drastic movement, or you can include the second candle, depending on the current price action or how conservative you are. For a demand zone, it's usually the last selling candle, a bearish candle, where the next candle closes above its high, formed just before a sudden, drastic upward rally. This also represents a typical sell-to-buy pattern. For a supply zone, it's usually the last buying candle, a bullish candle, where the next candle closes below its lowest point, formed just before a sharp, drastic downward drop. This represents a typical buy-to-sell pattern. It's up to you to choose any of the methods mentioned for drawing your supply and demand areas, but remember that each has its specific pros and cons. For example, if you use the range zone as your area of interest, you'll have a much larger stop loss, which can result in a smaller reward-to-risk ratio. However, the chance of missing trades will be reduced. On the other hand, a range zone can be refined to a pivot zone, resulting in a tighter stop loss and a higher reward-to-risk ratio. While this increases accuracy, it also leads to more frequent missed trades. We can't definitively say which method is better for drawing supply and demand areas or executing trades in the market, because profitability depends on many factors. Everyone has a different mindset, and a strategy that works well for one person might not work for another. The key to achieving a high-probability trading strategy is consistency. Stick to the rules and criteria you've developed through your experience in the market. Both methods can be effective in identifying valid supply and demand zones. The fractal model is the third method for drawing supply and demand zones, divided into 3 types. The first type of fractal model is the inside bar candle. This occurs within strong expansion waves, when the price cannot break above or below the previous candle's highest or lowest point, representing a range on a lower time frame. The second type of fractal model is the sell-to-buy or buy-to-sell wick zones. In a bullish scenario, when the price is in a strong upward push, the candlestick might not show any pullback in that time frame. It is just large momentum candles without forming a visible demand zone. However, the wicks often represent a pullback and a range on the lower time frame, indicating a lower time frame pivot or range demand zone. The same concept applies to the bearish scenario. The wicks between the higher time frame candles are the lower time frame ranges and represent a supply area. The third type of fractal zone occurs when the price creates large wicks. In these cases, you can optimize your large pivot supply or demand area by focusing on the candle's wick rather than the entire candle. This wick often represents a lower time frame pivot or range zone. We have thoroughly covered the basics of drawing supply and demand zones. Now let's review some essential tips and points for identifying strong supply and demand zones. One of the main factors to consider when measuring the strength of a supply or demand zone is the power and candlestick formation of the price during the expansion movement. The stronger the price moves away from a zone, the more out of balance supply and demand are at that zone. This indicates the footprint of a heavy order placed by smart money in that area, making it more likely that the price will respect and react to that zone. As you can see from the examples, when the expansion wave weakens, the supply area also becomes weaker and loses its strength. The most substantial supply area among the examples is where the expansion has the strongest bearish momentum. The second factor to consider is the time the price spends in a supply or demand zone. The less time the price spends in a zone, the more out of balance supply and demand are at that level, indicating a more aggressive entrance by smart money. Generally, the less time the price spends at a level, the stronger that level is. The third factor to consider is the freshness of the base area. Each time price mitigates a supply or demand area, it reduces the remaining supply or demand in that zone, weakening its strength. In this episode, we've covered the essential concepts of supply and demand areas, from basic to advanced, including the psychology behind these zones and how to correctly identify them in the market. In the next part of this video, we'll show you how to identify institutional supply and demand areas and use them to refine a profitable trading strategy and execute winning trades. Thank you for watching this video. I hope you found it informative and valuable. Don't forget to hit the subscribe button and turn on notifications to stay updated on our latest videos. We value your feedback and suggestions, so please leave your comments below and let us know what topics you'd like us to cover in our future videos. We appreciate your support and look forward to seeing you in the next episode.